Good morning, everybody. Just as people flow in, I'm going to leave a couple of minutes for this process to come through. Okay, I think that's everybody in. So welcome, everybody. Good morning. It's a great pleasure. Good afternoon, even, depending where you are in the world. It's a great pleasure to have you all with us today. My name's Molly. I lead the carbon strategy team at Burn, and we spent a lot of time over the last couple of years thinking very deeply about both carbon policy, but also carbon integrity. It's been a bit of a journey, as everybody knows, for the carbon sector in terms of integrity over the past few years. A couple of scandals, some crises, a lot of excellent work happening backstage and now front stage to make sure that the credits on offer are the highest quality credits available across the whole industry. Burn, as you may know, is a clean cooking project in Africa. We have projects in 12 countries across multiple fuel types. And certainly as a team, we've been doing a lot of thinking about integrity. What we're going to do today is introduce three great panelists. I've got a whole host of questions for them, but I think it's often more powerful if the attendees ask the questions. So please, we mean it when we say please do use the Q&A feature, and we'll try and pepper in your questions throughout the conversation as we go along. So it'll be a great pleasure to kick that off now. So if anybody has any questions, please go for it. While I give a very quick introduction to our panelists. So we're very lucky to have Mark Kember from VCMI, Henning Hundler from Bain, and Douglas Greenwell from Burn Manufacturing. I'm going to let them each introduce themselves as we go through. But first to say, I think from a kind of overarching perspective, as I mentioned, we've seen quite a lot of progress going on in the markets over the last couple of years. We're not going to focus specifically on the deep dives of, what exactly is FNRB and what exactly is new about the CLEAR methodology that's just been recently published by the UN for consultation. We're not going to go into the weeds. What we want to focus on today is navigating the VCM, the future VCM, so driving confidence in supply with the high integrity standards. So we really want to focus on the big picture of the supply side of the carbon markets and kind of, I guess, what this means next step. So I'm first going to turn to Mark. If you could kindly introduce yourself and let us know what does integrity look like for VCMI, and how do the ICVCM's principles play into that? Because there's a lot of acronyms, and it'd be great for you to explain a bit how that all fits together.
Great, thanks, Molly, and thanks for having me here this afternoon. So I'm Mark Kember. I'm the Executive Director of the Voluntary Carbon Market Integrity Initiative, and we work on two things in particular. One is trying to answer the question as to how and under what circumstances companies can credibly make voluntary use of carbon credits. So, and then what can they credibly say about it? So how does carbon credit use fit into broader climate transitions by corporates? And what kind of claims can they make? And that responds both to the need for companies to have certainty about what they can do and how they can do it with integrity, but also to be able to manage reputational risks and hopefully reputational opportunities around engaging with carbon markets. And we also then work on something called our Access Strategies program, where we provide through a regranting facility and a technical network support to countries or regions or sectors that want to do something to create an operating environment that means that carbon credits aren't just treated as another tropical soft commodity where every country competes to lower the price as far as it can possibly go. I always give the example of bananas. My wife's family are from Ecuador, and Ecuador is every now and then the world's largest exporter of bananas. And then one of the neighboring countries decides that it wants to be the world's largest exporter, so they devalue their currency, weaken their labor standards, weaken their environmental standards. And so the merry-go-round goes on. And I do fine living in the UK because I get cheap bananas, but the banana producers don't do very well out of it. So our access strategies work is trying to work with governments and sector organizations to help them think about how does carbon finance, how can carbon projects and carbon finance play a transformational role? And I don't know a huge amount about Bern's business, but my guess is that you would hope that at some point you get to a point of scale where carbon finance isn't necessary for people to buy your appliances, and that becomes the least cost, best option available. And that's where we see the role of carbon finance as a catalyst for technologies and skills and finance so that we're not relying on carbon credit finance forever, but this is a way of scaling up and disseminating and deploying technology. So that's what we do. I've been involved in carbon markets on and off for about 20, nearly 30 years now, and it's been a bumpy ride. And I think one of the issues has always been this sort of perception of what counts and what is integrity. And so, Molly, to answer your question, I think integrity is to do with trust. It's that, and it's to do with what's good enough. And I think one of the challenges we've had over the last 2 or 3 years is some of those of us who have been advocates for carbon markets, um, want to give the impression that every carbon credit is perfect. That makes us easy prey for those who say, oh, I found one that didn't work. And so integrity needs to be something that we can say is beyond reasonable doubt. This is contributing to climate mitigation. It's contributing to local and regional sustainable development. And it passes your average person's sniff test. And if we can do that in a grown-up way, I think that's how we will get to integrity. In practical terms, what VCMI thinks about is, so on the demand side, how companies operate with integrity is following the mitigation hierarchy, but not going down that route of saying it means exactly this. So a company does at any given moment what it can to decarbonize its own production, its own supply chains, and then goes above and beyond to use carbon credits, either to make up the difference to targets it set itself or signed up to internationally, or to go above and beyond good citizenship. I mean, it'll be interesting to hear from Henning. Bain have made a carbon integrity claim, which shows that they have reduced their emissions in line with science, and then have gone further by offsetting all their remaining emissions using high integrity credits. So integrity on the demand side means both and, not using carbon credits as an excuse for not decarbonizing. And companies that are going to get reputational benefit, are going to get real economic benefit, will be those who do decarbonize and buy carbon credits. And what we say in our guidance, and we've issued guidance and also driving governments to adopt that guidance as part of their policies, is that you need to buy high integrity carbon credits. And we define that as Article 6.4 or core carbon principle credits as issued by the Integrity Council for the Voluntary Carbon Market. And just to finish off, yes, it's a confusing world where you have one organization called VCMI and another one called ICVCM. For those of you who are film buffs, one of us is the People's Front of Integrity and the other is the Integrity People's Front. We are complementary, not competitors. ICVCM establishes what is high integrity on the supply side, i.e. the projects and the credits they issue, and we try and define what is high integrity on the use of those credits from the projects. So I'll leave it there. Thanks.
Thanks, Mark. That's super helpful. Douglas, turning to you. Firstly, please introduce yourself. But also, can you tell us what integrity looks like according to the CCPs for cooking? Like, what kind of thing have ICVCM looked for when they've screened and now approved certain, but not all, clean cooking methodologies?
Great. Thank you, Molly. And delighted to be here. By way of introduction, I'm the commercial director for the carbon projects for Bern. Looks like it's a tough act to follow there with Mark quoting Monty Python. I'm going to have to start thinking up some references myself in a moment. I'm also delighted to see so many other people join the webinar. I'm very conscious that it's a busy week for carbon professionals. You know, it's London Climate Action Week here. And even if you're not in London, I'm sure there are other events that you are able to join into. So thank you from from Bern to you for taking an hour out of your busy day to join. In answer to your question, Molly, I mean, let me kind of put it in real simple terms, and I think Mark kind of also talked about this very, very well, which is what the ICVCM has now done is set the benchmark of what the minimum standard should be as far as high integrity cook stove projects are concerned. And as you say, it's a specific methodologies. So there are there are 3 gold standard methodologies and 1 Vera methodology within that relating to cook stoves. But it's more than just the methodologies as far as cook stoves are concerned. There are 3 other factors that need to be taken into consideration. Probably the biggest and most debated is the adoption now of the MOFAS FNRB, and adopting that at the relevant country level. And then the second is the use of kitchen performance testing. And then third, where relevant, obviously for charcoal projects, is use of the agreed charcoal factor. Projects operating in all 3/4 of those particular instances are eligible for and can be labelled as a CCP labelled credits. And again, an important distinction I'm sure others will dive into. It's the credits that are labelled, not the projects, and this is a particular important distinction for gold standard in particular, because you're most certainly going to find during this transition period projects where there are going to be credits that, to all intents and purposes, we have managed at the same operational standard, but won't be CCP labelled because they're already issued, and then credits that will be CCP labelled from the same project because the labelling status was bestowed upon it before the issuances. But I think that will just be a temporary transition period and potentially provide some benefit, I think, again, for buyers and investors in these projects.
Thank you, Douglas. So now over to Henning. Bain itself has committed to the VCMI, which is very exciting, but I'm also aware that you do a lot of advisory work for other companies. So when you're recommending how people should think about building a high integrity portfolio, what kind of pieces are you thinking about, and how are you making the case for avoidance versus removals, high integrity labels? How do you recommend companies navigate this space?
Yeah, thank you. Maybe 2 words on us as Bain and what we do, what our role in the market is. So we're a strategy consulting firm. I lead our carbon markets advisory work here in Europe, which means I'm really on the kind of client-facing side. I help our clients understand and navigate carbon markets and make the decisions that fit to them as organizations. We have, of course, a second role within the market that you have briefly alluded to. We, of course, buy our own credits. We have a net zero ambition, a strategy to actually achieve that ambition and take carbon out of our business. And we are on track to achieve the intermediary SBTi commitment. But of course, then we buy carbon credits on top of that. And we were in the lucky position that we had invested relatively deeply to understand integrity, the choices that we need to make as buyers of carbon credits, and set up a carbon credit procurement program, which was already in line more or less with the VCMI's claims code of practice when it was published, I think 2 years ago, Mark, if I'm not mistaken. And so we were in the lucky position that we were able to make the first VCMI claim by any company globally. And so, of course, we're super proud of having achieved that. And at the same time, kind of we're trying to bring the lessons that we've learned internally to our clients, and of course, vice versa, to kind of continuously improve our own program. Now, in that client-facing role, when we speak to our clients about their carbon credit strategy, I think it's important to, before you step into deep portfolio discussions, you take a step back and think about the overall net zero strategy. What is the ambition? What is the pathway to net zero? How do you actually get carbon out of the business and don't see carbon credits as that alternative, but as Mark mentioned, as the complementary to that internal strategy for decarbonization? Once you have to find what your ambition is, how fast you can decarbonize, what the individual levers are to get carbon out of the business, to really embark on on an action path that lets you reliably get carbon out of the business. then you can start thinking about, okay, what's the role of carbon credits beyond that? What claims do you want to make? What is your ambition essentially beyond your value chain? And then based on the claims that you want to make, the kind of message you want to send into the market, think about what's the right portfolio to underpin those claims and allow you to make them reliably. In terms of your point regarding avoidance versus removals, I'm a big fan of the Oxford principles, and that's often a starting point when we get to this depth of discussion with many of our clients, where you start looking at what is available in the market right now, where can we deploy capital at scale, what are the climate solutions that we need to get up to speed as soon as possible. But at the same time, keep in mind what technologies do we need to scale to eventually get to global net zero, which means in the long run, we need to make sure that we manage to scale up removals to that 5 to 10 gigatons that the IPCC is recommending we need to get to at 2050. And so that's typically a starting point. But then, of course, depending on where a company stands, how their emissions look like, what industries they're exposed to, you start then making more individualized decisions and break this further down to develop a pathway that is really tailored to the organizations that we're working with. And then in my view, the integrity really plays a key role on the kind of credit level, the project level. So once you understand the overall portfolio, what you want to achieve, how that portfolio develops over time, then you can start thinking around how do we actually identify the credits that we want to buy, that we are comfortable with having in our portfolio, attaching our brand name to it, and of course also making disclosures around the procurement and retirement of those credits. And then, of course, the CCP, the core carbon principles, are of fundamental importance and getting more important year over year to provide a kind of a guidance of what types of credits are acceptable, meet certain quality requirements. I would also then think about that integrity and quality on an even deeper level. So where the CCPs really target or work on the standard and the methodology level, I believe it's also important to take a look further into the underlying project and understand how that might kind of also come with a bit of a normal distribution of integrity on factors that might play out on a kind of an even more granular level, really on the project, on the ground, rather than on the methodology and standards.
Yeah, you raised a very good point. I was actually going to ask all three of you the same question, which is, what do you think the CCP label does to due diligence? Because I think, 2 years ago, if I was a buyer and I was a bit worried about the kind of scandals and reputational risk, I would want to be really digging into the minutiae of projects. Now that I have this label, can I just buy and trust the label? What does that look like? I don't know if you want to do like a kind of a sentence or two each on this, because I do think it's interesting how this changes things. Do you want to go first, actually, Henning, while you're there?
Happy to. Again, the CCP, so far, of course, we haven't seen that many CCP eligible credits in the market. So that is something that we are eagerly waiting for. Once that is more widely available, I think it's a very, very good starting point. And I highly applaud the ICVCM for their work in assessing both standards and methodologies. And it's a gargantuan task of really sorting through the zoo of methodologies that the market has created over the last 15 years, but there is a level deeper. And so at least for now, until we also have individual projects and the whole certification infrastructure at a level that I can fully rely on this, I feel it's important to, as a buyer, also understand what is happening a level deeper than the CCPs.
Mark?
So I think first to just put the CCPs in a bit of context. So at the moment, core carbon principle label credits, I think, are about 3 or 4% of the market. And that's because most of the work has been done looking backwards, looking at the methodologies, the project types, and the credits that already exist. What we're already seeing is that, firstly, the main standards like gold standard, Vera, etc., have had to adapt their processes and their methodological approvals to fit the CCPs. And therefore, when methodologies are being developed in the future and future projects are being developed following the new methodologies, then we'll see far more CCP labeled credits in the market. So that may take 2 or 3 years, but it's already sending a signal because we can see there's a price premium for CCP labeled units both existing ones and future contracts vis-a-vis those that don't have the CCP label. So that's clearly already raising the bar, and to a certain extent, going to the due diligence point, perhaps it reflects the fact that companies feel they have to do less due diligence and therefore prepared to spend more on the credit because there's lower risk involved. That said, I think that companies will still need to do some kind of due diligence. Now, we may get to a point where these are all fully fungible credits, packaged in ETFs or whatever it may be, that are tradable on the market, and you just go into an exchange and you buy carbon credits. I think that will be part of the market, but there will still be an important part where companies want to buy certain credits from certain project types. Now, I don't know, I'm not party to Henning's internal checklist, but my guess is that Bain probably says, well, there are certain regions and certain project types that fit with our broader CSR or our sustainability strategy, and therefore we want something that's consistent with the narrative we're telling our employees, our shareholders, etc., etc. And then, while the CCPs provide comfort that a methodology is fit for purpose, it's good enough, it's rigorous, and the governance and the other processes around it are fit for purpose, that can never guarantee that a project will always succeed, or that a project may fail. I mean, if you buy stocks and shares on a stock market, if it's the London Stock Exchange, they've done their AML, they've done their KYC, they've done their due diligence, it's properly managed, there's enough capital in reserve. But that doesn't mean that the share price will always go up. Companies fail. Companies do well, others do badly. And that's why we've seen the emergence of ratings agencies who are looking at specific projects, and companies are paying for them, but they're also doing white label work for the market as a whole. And companies will, at least I think for the next few years, want to have that extra comfort that not only are they getting something that is widely recognized and widely acknowledged, the CCP label, but they're also knowing that the risks, the genuine risks, or the real risks associated with the specific projects and credits they buy from them.
Yeah, good point. I'm interested, Douglas, in your take on this, but also specifically in I guess, if CCPs are now the bare minimum, how can companies start thinking about going beyond that, and what's, I suppose, Bern doing to not just have the bare minimum in place, the methodologies, the FNRB, but like what else could be looked at by somebody doing a deeper due diligence or getting a rating from a ratings agency?
Yeah, before I kind of dive into that kind of beyond CCP, I mean, just to echo a couple of the points that definitely Mark and Henning have raised, which is, I don't think we're suddenly going to go from a binary, lots of due diligence to no due diligence. There'll definitely be a transition. But I want to pick on a particular word I think Mark used at the top of this webinar, which is about trust. And to me, what the CC label status does is I think hopefully it genders trust that a project is operating to a certain high integrity standard, and that particularly as far as the carbon is concerned within that particular project, they should trust that that credit represents a ton of carbon either removed or avoided, depending on the project type. And therefore, potentially where the due diligence is going to start focusing more and more maybe is actually on what the project is additionally about all the social benefits or the other elements that the carbon project brings, depending on the particular project type, and particularly where an organization is looking to invest in credits because of a climate contribution rather than a simple offsetting, and therefore this other chain of social benefits is much more important, or is as important. Then I wonder whether we actually start to see a lot more due diligence more around that, rather than trusting and having to check and validate that credit is actually a ton of carbon and will remain so over the period of time. But to build on your question, you're right. We should be seeing both as developers of projects and as buyers that the CCP methodologies and labels are now the minimum standard for high integrity. And what this, I think, will start to do, and I think you're already starting to see some early evidence of this, is we'll start to actually see some differentiation within the project types themselves of different projects, that the buyers will be able to discern the difference, and therefore why the price is a difference between them. Those that either are not CCP labeled, those that are CCP labeled, and those that go beyond. And if I kind of describe the sort of three areas that we focus on as a developer to go beyond, the first is actually the stove type that we produce for our projects. As you probably gather, the name Burn Manufacturer, we actually make our own stoves, and they're made to a high ISO based standard, so they're consistent, they're durable, and therefore we can rely on the fact that as a product will do what we expect it to do in the field, whether it was tested in a lab or otherwise. The second is the increased use of monitoring technology, whether that's electric, which is within its product already fully monitored, or the rollout of new DMRV technology for biomass stoves. That again is going to start giving further reassurance that the usage of these stoves is as described. And then lastly, within actually how these stoves are deployed. As an organization, we spend a lot of time, even before we design the project, surveying the territory, understanding the use case, understanding the cooking patterns that are present on the ground. And then we ensure that when we define the project, that we're deploying those stoves to those people where the greatest carbon benefit is accrued. And then we follow that up on a regular basis to ensure that the stove is then being used as described. And I would say they're just 4 examples of how we look at the CCP label standard and look to see how do we go beyond that? How do we actually set a point that, as far as our projects are concerned, and certainly some of the newer projects, they're higher than high integrity.
Thanks, Douglas. And I think this piece about versioning up is going to be quite important over the next couple of years. Emily's put a question in the chat about, if I do a design change to meet the CCP label, can I get that label? And the answer is absolutely yes. And I think we're expecting to see quite a lot of projects now recalculating, doing new baselines if necessary, or at least taking the new kind of FNRB values in order to be certified moving forwards. We are aware that the new FNRB numbers, which have been signed in by the UN Executive Board, are not perfect. I think everybody's aware of that, from the UN to all the project developers. So there's a question on that too in the chat. My personal take is that we have got to a point, I think, as an industry where we need to just have an answer and go for it. But what we're really encouraged by is the ICVCM and Gold Standard have both decided to approve MOFAS-derived values, which means they're not anchoring specifically to these versions of the defaults, but they're anchoring to the tool, the kind of increased integrity of the statistics. And my understanding is that both organizations are happy to take more data, maybe marginal MOFAS, urban MOFAS, national host country MOFAS. And when we speak to the UNFCCC, again, they've got a clause in their Tool 33 saying, if anybody has a better idea, more research comes to light, or as more data becomes available, I think there will be updates to MOFAS. So we're hoping that this is where we've got to for now. Let's take those numbers and run with it. But I think moving forwards, hopefully there's going to be more research, more data, etc. So Mark, I have a question for you.
Before you ask me the
go for it.
question, though, I just wanted to jump in on that. I mean, although I run VCM, I'm also on the board of ICVCM, and I think it's worth pointing out that ICVCM has a series of continuous improvement work programs, because it recognizes, and the MOFAS numbers for FNRB are an example, that we need something that works and something that's good enough, but there's also room for improvement. And so that this is kind of learning by doing approach, so that we can improve the standards, improve the guidance over time without creating too much uncertainty for those who are investing now. So I think that when you talk about the transition to new methodologies, there are 2 different things at play here. One is methodologies in categories. So in broad categories, there are some methodologies that have not been approved. And I think the most famous ones are in the RED Plus space, but there may be some in the clean cooking space as well, where the message from the ICVCM, think about renewable energy, grid connected renewable energy, and RED being the best examples, where they said these are clearly important categories, along with clean cooking. Those are probably the 3 most important categories in the carbon markets. In the renewable energy, grid-connected renewable energy space, there was not a single methodology that was considered fit for purpose. They were old CDM methodologies. As we know, large-scale renewables, the cost has come down dramatically, and therefore there were lots of non-additional projects that were being approved. So there, the ICVCM said very clearly, it's not that we're against grid-connected renewable energy, just the current methodologies aren't fit for purpose. So the challenge to the world is come back with some methodologies that work so that in those countries or those regions where grid-scale renewables are additional, they can get credits. In the case of RED Plus, it's, well, how do we improve the methodologies? And Vera has done this with what's called VM48 and is providing a transition process for those who have projects using the old versions of the methodology to transition to the new methodology and therefore get CCP labeled, recognizing that, those who invested using the old methodologies did so by and large in good faith, and therefore this is not to punish them, but actually give them an opportunity to transition. Then there's a second piece where there are going to be continuous improvement. And I think that's not about transitioning to a new methodology. And there, it's very clear that if you used a methodology using whatever emissions factors you were best fit for purpose at the time, then you will not be punished by having to change that every 2 or 3 years. So the one thing is transitioning to a new methodology, and the other is as methodologies get updated with more knowledge, for that first crediting period, at least, you're not punished and you don't have to go back and start all over again. And it's worth distinguishing between those two cases. Sorry, Molly, I interrupted you.
No, that's fine. You basically said what I was I think you might say. Because the question was going to be, how do we manage this piece about continuous improvement? And maybe, Henning, you can talk to this. Because what we think right now is best practice that's come out in the latest methodology, it will take project developers a year or so to integrate, then it will take a year or so for the credits to come out. And cooking has a very short time frame, which is an interesting and quite cool piece about cooking, is that between starting a project and issuing credits can be as short as a year and a half, 2 years. But what that means is that best practice right now, starting with a digital sensor on the stove from the very beginning, first day, distribution day dot, those credits won't be available for another year or so. Whereas the credits that are being issued now are typically credits from stoves that were distributed a year, 2 years ago, where we did what was best practice then. So Henning, how do you think we should think about this continuous improvement piece? Because we need to keep the market moving while we wait. We can't wait for perfection, basically.
Yeah, look, I fundamentally agree with that last statement. We can't wait for perfection because it's too urgent for that. I do think that, of course, creates complications on both the supply and the demand side. The buyers, of course, are concerned that in a couple of years, maybe they sign an offtake agreement because they want to kind of provide also the finance and the security needed for the developer to put their projects into reality. They're, of course, then worried that 5 years down the road, they're going to be left with credits that by that point might not be kind of acceptable or meeting their high bar anymore. And of course, on the supply side, you also need to have some certainty if you make an investment now that that asset will have a certain value in the future. I think overall, it's a problem where we don't have a perfect solution for, but I think we all need to understand that this continuous improvement will have to happen, not just on the standards and the methodology side, but also to some extent on the project side. So we need that kind of the willingness by the developers to constantly think through what adjustments can we make if we go into the next crediting period. Do we need to upgrade to a new version of a methodology to make sure that the project is continuing to be certified under the evolving best practices? But at the same time, we need a kind of a willingness to accept on the buyer side, but also more broadly on the social society, that systems are not perfect. We're doing what we can to improve quality and integrity. But as standards are improving, we need to be forgiving to buyers that made investment decisions right now that might then in 5 years realize, we still didn't get everything perfect. We're continuing to improve rather than publicly shaming companies for making investment decisions based on the best practices at that time.
Totally. Thank you. Douglas, I'm interested in your take on this, but I'm also interested in price, which is one of the questions, again, in the chat and something that Mark mentioned earlier. So we saw that recent work by Abatable, published about cook stoves, was showing that in the kind of new CCP world, cook stove credits will be around $15 for floor price, with more like $30 to $40 for higher kind of modern fuels. What's your take on this kind of evolving integrity standards? Who should pay for quality? And how do we kind of manage to keep projects both viable for the developers, viable for the communities, but also, I guess, affordable for the companies that need to buy them?
Yeah, another great question there, Molly. And there's probably not a huge amount I could add to both the answer that Mark and Henning has given on the continuous improvement. And I guess if there's any guidance I was giving to a buying organization who wanted to lock in a kind of forward supply, is this is all about your risk mitigation over time. And I would always suggest and advise that if you see this market as a market that is going to evolve and is going to improve, then don't buy at the minimum standard. Don't buy at the minimum standard, which might be fine today. I think, again, I'm going to steal the phrase that Mark used, good enough, but may not be good enough in 3 to 5 years' time. So buy at the standard above. Anticipate how that improvement may change over time, such that potentially by the end of your forward period, the market will have caught up, and potentially hold us developers to account as well. As you said, Molly, I mean, these things take time. They take time for us to adapt. Don't expect us to suddenly change everything within a year or so. But if it's a particularly long-term agreement, then let's make sure we've got some improvement milestones within there, and that the project isn't necessarily exactly the same as it was in the first day versus the very last day would be my thoughts as confidence comes in and people start looking more and more, particularly in Cookstows, at securing a longer term supply beyond spot. The abatable report was super interesting, and I think this whole area of pricing for carbon credits in particular, as a whole, and Cookstows in particular. I'm not a pricing expert. There are probably others that can describe this far better than I. And what I do recognise is, at the end of the day, this is subject to a market, and it's subject to the market dynamics, which is the dynamics of kind of a simple supply and demand equation. However, the other dynamic that definitely appears to be missing in its whole form from the market is one of differentiation, of one understanding that actually no two carbon credits are equal. And there are multiple points of difference, one of which we're describing here today in terms of the integrity of that credit, the reliability, its risk profile, whether it's around the credit representing a ton of carbon or otherwise. But some of it is also about the narrative that sits behind the credit. And the reason I'm kind of highlighting this is that when we think about price and we think about high integrity projects going forward, we need to think about the contribution those credits are having. At the end of the day, it's not a perfect vehicle, but it's the best vehicle I think we've got, carbon financing, to transition money, broadly speaking, from global north to global south, and to drive both economic and social benefit through that particular transition. And increasingly, projects, rather than simply thinking of this from a cost plus point of view, I've got fewer credits, I need to charge more. Increasingly, projects need to be very, very good at describing those social benefits, those climate benefits beyond the ton of carbon, and need to therefore reflect the benefit we're driving through its price. And then equally, the buyers, to a certain degree, need to appreciate the benefit that they're driving into local communities through this particular project. So through that, I mean, certainly we're aligned with abatable, and we're seeing, I guess, when you look at some of the other forces that are coming in around the market, around driving demand within the carbon markets, and Corsair in particular, other Article 6, we're definitely starting to see trends that, as far as Cookstows are concerned, pricing between $15 to $20 for biomass type stoves, higher for, as you say, more high integrity, maybe electric based stoves, are becoming more commonplace as a described price, and in some cases, as some of the transactions. So I certainly would say, to buyers out there, the old adage of highly differentiated, high quality, high integrity credits will carry with it the appropriate premium price point. And this is not going to be an overnight thing. This is going to emerge over time, but probably more quickly than people may expect.
Thank you, Douglas. I'm curious, Mark, you spend a lot of time talking to companies at a high level, kind of advocating for the VCMI approach, to both to companies spending money quite a lot of money, in fact, on near-term decarbonisation, but also on buying integrity credits. Like, what's your kind of sense? Like, are companies ready to pay more for quality?
So I think let's put it in a bit of context. And there are two things points I'd like to make. One is, and I think it goes without saying that the science of climate change suggests that we need to mitigate a lot more quickly than we are at the moment. And that requires both companies decarbonizing their value chains, partly because they're responsible for emissions and partly because that drives product and process changes, technology development, deployment, scaling, and so on and so forth. But that there is also a need to invest outside their value chains, and carbon credits are probably the main way to do that. That leads me to talk about the mitigation hierarchy, which others have mentioned. And the mitigation hierarchy, or the Oxford principles, sort of very clear. First, avoid emitting in the first place, then reduce your emissions. Once you've done all of that, then look outside your value chain to buy carbon credits and other types of market-based instruments. That, to my mind, has been slightly perverted or corrupted to mean reduce your emissions in line with what the science says, and only then buy carbon credits. And if you can't do that, then you shouldn't be entering the market. And I think that is plainly wrong, and I think it's foolish. So how I would interpret that is that companies should do everything they can, and everything they can will be defined to a certain extent by the company themselves. There may be barriers that are, that next ton of internal mitigation costs $10,000, and you're just not going to do it. Or the technology is not available, or you don't have the skills, and it may take 2 or 3 years. And in my view, every single year that you are not on track or you're off track, you should be buying carbon credits at a minimum to take responsibility to fill that gap, and then go above and beyond in the way that Bain, Natura, and other companies have done. So I think we need to understand the mitigation hierarchy in a slightly more nuanced way, not to say, yes, this is a get out of jail free card, or this is a cheat, rather than this is a responsibility. We recognize that those last 10 or 20% of emission reductions are really the most expensive ones that companies can face, and often prohibitively so. That shouldn't be excuse not to take action. Then you should be buying carbon credits. Now, if we have, and so for example, this morning, the governments of Kenya, Singapore, and UK launched a coalition to try and drive demand-driving policies and regulations and guidance for companies. Then, if we do get to the sort of scale that those governments hope to reach, so a carbon credit market or voluntary use of carbon credits that is a factor of 10 or 100 greater than it is now, then I think it's axiomatic to a certain extent that the price will go up. And the price will be determined partly by demand and partly by the upper level, by how much it costs companies to reduce their emissions. So I think then we can get to a point where we do get a decent price. I mean, carbon credits selling at $3, $4, $5 a ton, when we expect them to do 2 rounds of independent verification and validation and a whole bunch of absolutely necessary and legitimate free and prior informed consent exercises, etc., you then have to ask how much actually still is left for the project and for the local community. So we need to have higher prices. Those higher prices will still be a lot lower than what companies may have to pay for mitigation. This is why emissions trading schemes work, because the overall aim is to get as much mitigation as possible at the lowest cost possible. So if we have good regulation, good policy, good voluntary joined up standards where companies can use carbon credits, not as a way out, but as a way to take responsibility each and every year rather than just in every 5 years when they have a target, then I think we'll get higher prices, which will drive better quality projects with better benefits for the local communities, therefore make the projects more sustainable, while at the same time allowing more overall mitigation because companies can do more because it costs them less.
Completely agree. I'm going to start taking questions from the audience. I mean, we've been dripping these through, but we've got 13 minutes left. So if you do have burning questions, please put them on the chat. But Henning, I'm going to come to you.
No pun intended, I assume, Molly.
No, not at all. Henning, I'm going to come to you partly because I'm interested in your take on price and what you're hearing from your customers and clients about price, but also because of the question that Olivier's put here, which is that the more high integrity and the more the gateposts move and the methodologies get tighter and tighter, the less viable projects are unless this price goes up. So how are you thinking about this in terms of supply demand? What are clients saying? do clients care about the financial viability for a project developer, or are they just wanting to get what they can at the lowest possible price?
I mean, look, I think there's of course different buyers out there, right? And different buyers approach the market with different objectives and different KPIs that they're optimizing for. I think the companies that are really looking at carbon markets as a meaningful tool to drive global decarbonization are fully acknowledging that, you know, in order to develop a high quality project that has certain quality characteristics, that meets certain thresholds, you know, that comes with a price. And if you're looking to buy credits for $1 or 3 to 5 or whatever it is, you simply can't expect to get it all, which is a high quality credit that has been validated, verified, certified. You get a rating on top of that, and on top, of course, you have all sorts of co-benefits and high additionality and the like. So this clearly doesn't work, and I think increasingly the market understands that, and the people that really look at carbon markets in seriousness, they acknowledge that. Now, that does not necessarily mean that they're going to pay every price that a developer is asking for. Of course, there needs to be kind of a nuance to that, and of course, markets are have as one of their core features price discovery and efficiently allocating capital. So we shouldn't expect the market to just indefinitely, you know, raise prices for high quality credits, but find a common ground that acknowledges kind of the competing demands to how the market will work. And then, you know, if you look at portfolio constructions and the way that companies are looking at their overall cost of carbon, of course, if you build a portfolio that is, let's say, aligned with the Oxford principles and that works with partially avoidance credits, partially removal credits, different types of nature versus technology, you'll quickly also get to a portfolio approach to the pricing, and you arrive at a weighted cost of capital, a weighted cost of carbon, that then a buyer also needs to calibrate with the budget they have available and their willingness to overall contribute to climate action. In my perspective, if you have a constrained budget, as most of our clients have, it's probably better to look at threshold quality and then calibrate the volume that you're offsetting versus try to maximize the volume at the cost of minimizing the price, and you know, which then comes at the cost of the quality that you're getting.
Totally. And I think there's a question here from Virginia about smaller project developers who are probably less, you know, backed in terms of capital. Like, it's a bit harder to follow all the new rules. Like, Mark, how do you think ICVCM's thinking about the kind of smaller developers? Is it actually helpful to have kind of stricter rules that they just follow these rules? Or do you think there's a risk potentially that some of the smaller developers get left behind?
So I think that's certainly a risk. I don't think, and I'm not speaking for ICVCM here. I'm speaking sort of over 20 odd years of having been involved with Vera and Gold Standard and latterly with ICVCM. We've had a lot of debate about small projects and how do you create rules that maintain integrity without pricing them out of the market. And I think the general consensus is that saying just because something is small, therefore it should have rules that allow it to be perceived with lower integrity is not the answer, because it leads to lower prices, less interest, and that's not what we want at all. So I think the question and the innovation that we need collectively to find is, how do we reduce the costs, the sort of fixed transaction costs of those projects, the cost of verification, the cost of validation, the cost of project development? How do we do all that in a way that enables those projects to operate and command decent prices and meet those high integrity standards, rather than saying just because you're small or whatever, then you can be lower quality? And I think there are a number of ways of getting that. I mean, I think there's a conversation with the philanthropic sector, which, you know, that early project development, some of the help to bundle projects together, help project developers learn from each other, have methodologies that don't require continual reinvention. That's a way of bringing down the cost. Is there a way of having local validators and verifiers, so you're not paying for some expensive international organization coming in to validate your product? Is there a way, for example, you could have a local verifier? And I know a lot of the capacity building work around the world, including in Africa, is trying to train local auditors and verifiers. Is there a way they could do that sort of with the sponsorship, not financial, but professional sponsorship of the large international firms. So there's a sort of an imprimatur of, for example, DNV or Tuva or whoever happens to be, but it's the local firm that does the work. Is there a way that several projects could be bundled together for validation and verification so that they save on some of those fixed transaction costs? And I think that's the approach we need to do. What are the methodologies that are applicable to small scale projects that may cost less to implement, but don't reduce the quality? Because going back to what I said again, if they are perceived to be of lower quality, then the end people will not buy them. And so it's how do we reduce the cost rather than relaxing the rules?
Totally. I'm aware we're running out of time, but Henning, I'm interested in your take on one final point, which is about supply of CCP credits, because there is this, increased hurdle to jump to, potentially fewer credits, maybe greater risk with price. And also, I think we're going to see more competition as project developers start looking towards am I putting my credits through a CORSIA pathway or a CCP pathway? Those may converge. But do you think there's enough supply of CCP credits, or likely to be, and will that change price?
So I think, tying this back to what Mark mentioned earlier, I think you said roughly 4% of available credits in the market right now are CCP eligible. So I think that very clearly answers the question, do we have sufficient supply already? For sure not. Do we expect that to grow? Yes, of course. I mean, as the ICVCM continues their work, as the standards upgrade their methodologies to newer versions and developers eventually apply those methodologies, yes, we'll definitely expect supply to grow. I think if you are kind of thinking about where to sell your credits to, right? Is it CORSIA? Is it voluntary buyers? Is it maybe also domestic compliance, either markets or tax schemes? I think as a developer, it's important to understand what are the potential sources of demand that your credit is eligible for. So understanding the optionality, and this can be a very, very complex process because you have so many different schemes globally. And so understanding your potential buyers and then making a decision simply on, well, to me, it's eventually boils down to price, or at least price is an important factor in this equation. Understanding what is the price that it will emerge in CORSIA. And I think there, of course, eventually we'll get to a probably more transparency than we'll have in the voluntary market, simply because it is a compliance market. It will likely be a much more standardized than commodity markets for every credit that meets the requirements. And comparing that with the price levels that you're going to get for certain credits with a CCP label in voluntary markets, that will then help developers really make that informed decision of where to sell to. Do I appreciate that competition with CORSIA with the voluntary market? Yeah, absolutely. I mean, it's another source of demand. It's another driver of growth that we desperately need. And if that has as a consequence that we raise prices, I fundamentally believe that is a good thing, even if that means for us as a buyer that we're likely going to pay a higher price. But I fundamentally believe that's eventually going to be catalytic for the market, and it will attract more investors and more supply, and eventually contribute to a much more liquid market than we have right now.
Totally. I'm going to go to final round, quick fire predictions. What do we think? Questions. Douglas, do you want to go first? I'm also interested in the CCP CORSIA question, but we're running out of time. So maybe the high level version, and then where do you think we'll be in 2027 with integrity?
I fundamentally believe the two key phrases that are in place now is trust and differentiation. And so when I think about integrity, I think about how we're bringing trust back into these projects and into the markets, which will bring hopefully buyer certainty, and I think will bring better differentiation as well across the projects, which again will give buyer choice. So I think in 2027, I'm expecting to see greater trust and greater differentiation.
Mark?
I think, and I'm hesitant about saying this because I seem to find myself saying this about every 5 years, that over the next 2 years, this market is going to take off. And I say that, and then I look foolish 3 or 4 years later. But I think there are good tailwinds at the moment. I think this coalition that I mentioned earlier that's announced this morning that will give guidance to companies and give them comfort to buy will help. I think the new methodologies, the work of the CCP, the ICVCM, I think the Article 6.4 supervisory body has learnt the lessons of the CDM, that it can't take 10 years to approve everything, but has also now got some, the rules on baselines that they adopted in April. They're pretty ambitious, and that's a really good sign. So I think that will build trust and confidence. While the voluntary part of the market has been flat for the last year or two, and the most recent ecosystem marketplace report was not hugely optimistic about the number of issuances and retirements, there are also numbers behind the scenes. The 16.3 billion that was invested in project pipeline. I was at the Innovation for Climate conference along with Douglas last week or the week before. And it was really interesting how much more professional the conversation has become, and how many organizations that bring real expertise in how markets work, how verification work, how project finance works. This is not just being run by a bunch of well-meaning NGOs like me. It's run by people who really know what they're talking about and, understand risk. And then finally, all the new technological tools that have come into play around MRV, but also around the technology project themselves. Feels to me that people are investing in these things because they believe there is a brighter, if not a fully bright future ahead of us. So I think I'm not going to bet my pension on it, but I think in a couple of years' time, I think we'll see a market that is much more robust, that is growing, but most importantly, is seen and accepted to be a relevant and legitimate part of all the things we need to do to address climate change.
Thank you, Mark. Henning, final word?
Well, look, I fully agree with Mark. I think long term, I'm bullish on the market, and we see strong tailwinds that eventually will drive that acceptance that Mark is speaking about. But yes, will this happen in the next 6 to 12 months? We'll see. So I could definitely see that sidewards movement that Mark was speaking about continue for a year or two. And until that kind of acceptance slowly kicks in, governments support the market much stronger than they're currently doing. The NGO community kind of wraps their head around the new structures that we have in place to guarantee quality and integrity in the market. So yes, I mean, a similar verdict as Mark has given here.
Well, wonderful. We're exactly on the hour, so I won't keep anyone very much longer, but I'd like to thank our panelists for their time and our attendees for joining us and for sharing such insightful questions. We will hopefully stay in touch with everybody and let's see where we get to by 2027. I think it's exciting that certainly from the cook stove space, at least, CCPs are finally here. And let's see what that does in terms of bringing some demand back and helping drive really important impact in the global south. So thanks everybody. Have a lovely afternoon and rest of the day.
Thank you very much.
Thank you.
Thank you.
Bye.
Bye-bye.